The Central Bank of Japan has surprised global markets this Friday by lowering its benchmark interest rate to minus 0.1%. That's seen as a dramatic step, and it means that commercial lenders will effectively be charged when they make deposits at the Bank of Japan. The aim is to boost stubbornly low inflation rates, and with that, the Japanese economy. Let's talk more about what this means now with Richard Perry, analyst at Hantec Markets in London. Thank you very much indeed for being with us, Richard. First, could you tell us a little bit more about what a negative interest rate actually is and what the Bank of Japan is after here?
Well, negative interest rates are, as you said, basically whereby effectively financial institutions are effectively charged for holding their deposits at the central bank. Now, you can't actually obviously charge individuals negative interest rates because effectively they just pile their money under the mattress. But you can do that to financial institutions in an attempt to try and generate some sort of lending into the economy and also to try and stimulate credit growth. Now, obviously that is the primary aim, I think, of what the Bank of Japan is trying to do, because they need to try and generate some inflation through the system. And they do that by the aim of negative interest rates is to also to bring down the longer-term bond yields and effectively longer-term interest rates. So that helps to generate inflation, and that is one of the things that the Bank of Japan so desperately needs, because at the moment it's fighting off deflationary forces all over the place. You've got the falling oil prices and also the fact that you've got the strengthening yen, and these two factors are really impacting on inflation in Japan, and they needed to act, and they've seen to do that today.
So in theory, it sounds pretty good, this move by the Bank of Japan. But are there any risks involved?
Well, there are clearly risks involved. I mean, if you look at the theory behind it, you'd say that investors are have got to basically look for more riskier assets to try and generate their income, and with that, we live in a world where now the debt levels are going through the roof again, and that could also have a knock-on effect on the fact that the whole risk appetite element of the market is increasing. So you need to sort of bear in mind that there are increased risks that come with this. But also the fact is that the banks themselves find it harder and harder to generate income. Their profit margins are squeezed because they can't pass on that negative interest rate to their customers. So in the long term, it actually has a possible negative impact in the way that these banks are meant to be the forces that are driving the recovery, and if they're not getting the profits through their general business, then that has an impact further down the line as well. So it has a potential to be a negative as well. But generally speaking, if you look at the experience of the ECB and the Eurozone, it's pretty much been a fairly positive move. You've had all the required impacts on the markets coming through. You've had bond yields coming down. You've had credit growth started to come through the system, although there was a point in 2015 where credit growth started to tail off, and that was one of the reasons why the ECB sought to extend the further negative deposit rate. But also, you've got the fact that inflation has picked up in the Eurozone in the past year. It's up around about 1% from the absolute low of 0.6% negative to today at 0.4% positive. So it does have positives, but also you've got to bear in mind the negatives possibly further down the line.
Now, the ECB has taken the step to bring its interest rates negative. Do you think, though, that it will work for Japan and under Japanese current conditions?
Well, you've got to look at the fact that the Bank of Japan already owns about a third of the JGB's market, so it could potentially further distort that market and create some real liquidity issues in the bond market. So it's not necessarily going to be a guaranteed winner for the BOJ, but certainly in the experience of the ECB, they seem to be doing the right thing at the moment. But obviously, they're having to extend. They've done it 3 times now. They've sort of increased it by 10 basis or decreased the deposit rate by 10 basis points. So the Bank of Japan have already stated that they may well need to go further. So it seems as though that they're going to really throw the kitchen sink at this one.
Okay, I just want to get your thoughts as well regarding American growth, because we just got through some pretty lackluster growth figures from the American economy in the fourth quarter. Were you surprised to see that?
I'll be honest, I wasn't overly surprised because I look at all the regional Fed surveys and they've been telling me that the US has been slowing down for quite a while now, and it certainly has been filtering through the system, these sort of declining growth numbers, and the expectation was not met today, and that to me wasn't a surprise. It seems as though there is a real sort of dichotomy in the US between the manufacturing and consumer sectors, and the consumer sector is still doing okay. That is generating the growth in the States, but the manufacturing side is still sort of continuing to slow down, and that is a real drag on the economy. And it tends to be that the market sort of, the ISM manufacturing data tends to be a bit of a harbinger for the growth figures, and that manufacturing PMI is not great. And we're going to get the next one out on Monday, and that could well again be a bit of an indicator of further slowdown. So it's interesting to see that on Monday, I think.
Okay, one to watch next week. Thank you very much indeed, Richard Perry, for speaking to us.